Walk into Liam's place, and you feel it right away. Nothing flashy about it. 4 bedrooms, colonial style, solid neighborhood, nothing that's going to make anybody stop and stare. The kitchen still has the same countertops from 2019. His car is a 4-year-old Camry he dropped $31,000 cash on and fully intends to drive until something major gives out. He puts in around 44 hours a week, takes 3 actual vacations every year, and when the market tanked 28% in 2022, he went out for a run, came back home, and didn't even look at his account for 2 solid weeks. Liam is 46. His net worth sits at $1.84 million. Now step into Harry's place. Harry lives about 3 miles away. He leases a $72,000 BMW he renegotiated last year into something a little more sensible. His kitchen got a full gut renovation in 2021 that ran $47,000. He's got a brokerage account spread across 6 stocks he truly believes in. A home worth $850,000 he can't unload without torching that 3.1% mortgage rate, and a financial picture that looks sharp from the outside but feels genuinely shaky from the inside. Harry watches his portfolio every time the market twitches. He grinds 58 hours a week. Most years, he out-earns Liam. Harry is also 46. His net worth is $312,000. Same city, same starting income, same era. One of them actually built wealth, the other one financed the look of it. This isn't a video about getting started building wealth. It's about every specific trap that's sitting right in your path once you already have something going. The ones that are completely invisible when you're broke and get brutally expensive the second you're not. My name is Nick, and I spend way too much time trying to figure out why people who should be financially free end up financially stuck. That's something you don't want to be. Make sure you subscribe because we're going through every single one. Trap 1, lifestyle creep, and why it only gets worse the more you earn. Let's kick things off with the one that's probably already happening to you right now, whether you've fully caught on or not. Goldman Sachs surveyed over 5,000 Americans for their 2025 retirement report. And buried deep in that data is a number I can't stop thinking about. Among households pulling in between $250,000 and $500,000 a year, about 43% say they're living paycheck paycheck. For households clearing over $500,000, that number is still nearly 40%. Close to half the people making $500,000 a year have almost nothing left when the month wraps up. Here's what makes this genuinely hard to wrap your head around. It actually gets worse the higher you climb. Households in the $200,000 to $300,000 range only reported a 16% paycheck rate. Something doesn't just grow on the way up, it speeds up. And that something is your standard of living, silently swallowing every dollar of every raise before you even realize it walked out the door. There's a concept called the Diderot effect, named after a French philosopher who got a beautiful scarlet robe as a gift and wound up in debt replacing every single piece of furniture in his room to match it. The desk looked beat up next to the robe. Then the chair looked off next to the desk. Then the rug. Then the art. He called it his dangerous new companion. Economists call it consumption cascade. Your brain just calls it, I earned this. And it doesn't pump the brakes until the money's gone. You upgrade the apartment. Now the furniture looks out of place. You fix the furniture. Now the car feels embarrassing. You fix the car. Now the neighborhood doesn't feel right. Every single purchase makes complete sense on its own. Together, they eat up your entire net worth growth year after year without ever feeling like you're overspending. The fix is simple, but not comfortable. When your income goes up, your savings rate goes up first, before your lifestyle gets a single dollar of it. If you land a $15,000 raise, $8,000 goes straight into investments before you feel a thing. That one rule, applied consistently, is probably worth $400,000 over the course of a career. And if you skip it, Goldman Sachs' data makes pretty clear you'll find creative ways to spend $500,000 a year and still feel like you're coming up short. Trap 2. Overconcentration in a single asset. This one tends to hit people who've actually had some real wins, which is exactly what makes it more dangerous. Tell me if this sounds familiar. You bought something, a stock, a piece of real estate, your company's equity, and it ran up hard. You mentioned it to a buddy at some point, maybe casually, maybe not so casually, and now you've got a relationship with this thing. It's woven into how you see yourself financially. Selling feels like giving up on it, or like admitting you never really believed in it to begin with. So you hold and you keep holding while the position quietly grows into a bigger and bigger slice of everything you own. You are technically gambling at that point. You just don't feel like it because it's been working. Intel was one of the most celebrated tech companies on the planet back in 2000. Not some risky startup, a dominant, profitable company with real earnings to back it up. It peaked around $75 a share during the dot-com boom. Within 14 days of that peak, it had dropped 20%. Within 22 days, 36%. After a revenue warning that September, it fell 40% in a single trading session. By late 2002, it was trading around $12. That's an 82% decline. And here's the part that still gets me. It still hasn't climbed back to where it was in 2000. Someone who went all in on Intel at the peak didn't just lag the market. They've been waiting 25 years just to get back to even. But Intel isn't really the cautionary tale here. Intel is just the one you can throw up on a chart. JP Morgan dug through every Russell 3000 stock from 1980 to 2014, roughly 13,000 companies, and found that 40% suffered a permanent decline of 70% or more from their peak value. In tech specifically, nearly 2/3 experienced catastrophic losses. The index still looks fine because a small group of massive winners covered for everybody else. You don't get to know which bucket your stock falls into before you have to decide how much of it to hold. The rule most portfolio managers land on: no single position above 10% of your total portfolio. Most say 5% is the safer number. The attachment is the trap, not the asset itself. Trap 3, tax inefficiency, the slow bleed nobody ever notices. You had a great year. Portfolio's up. You sold a position that doubled. You're feeling good about things. Then March shows up. You crack open TurboTax, and you're staring at a number that doesn't add up. You made $60,000 on that trade. You owe $24,480 in taxes. Not because you did anything shady, not because you got flagged for an audit, because you sold in month 11 instead of month 13. You're on the hook for nearly $10,000 in taxes you didn't have to pay on a single $50,000 gain, just because you got a little impatient. That is what tax inefficiency looks like. Not fraud, not some complicated scheme, just timing mistakes and placement errors that nobody ever sat you down and walked you through. Morningstar found that the average equity mutual fund gave back 1.48% of its returns every year to taxes. Compound that over 20 years, and you're looking at roughly a 35% reduction in ending wealth. On a $500,000 portfolio, that's about $175,000 gone. Not from bad investments, not from a market crash, but from sloppy tax management. The most common mistakes: holding high dividend stocks and REITs in a taxable brokerage instead of an IRA, where every dividend triggers a taxable event whether you wanted to sell anything or not. Harvesting losses. When a position is underwater, selling it lets you lock in a loss you can use to offset gains somewhere else without changing your overall market exposure. And selling before you've held a full year, because short-term gains get taxed at up to 43.4%, including the net investment income tax, while long-term gains max out at 23.8%. That 19.6-point spread cost you $9,800 on a $50,000 gain because you couldn't sit on your hands for 2 more months. Taxes are almost certainly your single biggest annual expense. Bigger than your mortgage, bigger than anything else on your statement. The wealthy don't always earn more. They just make sure the ears takes as little of it as the law allows. Trap 4. Overconfidence after early wins. This one specifically targets smart people who've actually done things right, which is what makes it so effective. You had a couple of good years, the stocks you picked went up, the real estate deal paid off, the business grew faster than you projected, and your brain naturally files all of that under "I'm good at this." Psychologists call it self-attribution bias. We give ourselves credit for the gains and blame outside forces for the losses. It's not a character flaw, it's just how human cognition is wired. But in investing, that wiring gets expensive fast. I've watched this play out with people I actually know. One strong year in a bull market, and suddenly they're concentrating positions, dabbling in options, buying on margin, going from a diversified portfolio to 5 names they feel great about. The boring index fund that was quietly compounding in the background turns into a trading account that needs daily attention and delivers monthly anxiety. And here's the thing, for a while it keeps working. Because markets generally trend up, and a rising tide has a way of making everyone feel like they've cracked the code. The academic research on this is pretty blunt. Researchers tracked nearly 20,000 people who got into day trading equity futures. Among those who kept at it for more than 300 days, 97% lost money. Not most, 97%. Only 17 people out of nearly 20,000 managed to earn more than local minimum wage through trading. The researchers found no evidence of improvement over time. Performance actually got worse the longer people stayed in it. The market has a very specific sense of humor. A bull market is not a performance review. When the whole market is up 25% and your portfolio is up 25%, that tells you almost nothing about your ability. The real test is what happens when conditions shift. And by the time they do, overconfidence has usually already pushed you way out on the risk curve, which is exactly the worst moment to be there. The counterintuitive protection here is boredom. The most effective strategy for most people is aggressively dull. Broad index funds, automatic contributions, minimal tinkering. The moment investing starts feeling like entertainment, that's usually a warning sign, not a green light. Trap 5. Working too hard for too long. Nobody ever calls this a financial trap, but it absolutely is one. There's a point in the wealth building journey where your time becomes worth substantially more than whatever your next paycheck adds. And most people blow right past that moment without blinking because working hard is what got them here, and slowing down feels like falling behind. Run the math on this. $5 million invested at a conservative 5% annual return throws off $250,000 a year. That's $684 a day, weekdays, weekends, holidays, days you're flat on your back sick. At that level, every additional hour you put in has to justify itself against the shrinking return of piling more income on top of $684 in passive daily income. Past a certain threshold, you're not working for the money anymore. You're working out of habit. Bronnie Ware spent 8 years as a palliative care nurse in Australia, sitting with patients in their final 12 weeks of life. She documented the 5 most common regrets people shared at the end. Number 2, voiced by practically every male patient she cared for, was this: "I wish I hadn't worked so hard." Not "I wish I'd earned more." Not "I wish I'd taken bigger swings." "I wish I hadn't worked so hard." The question worth sitting with is pretty straightforward. What is your time actually worth now compared to when you were just getting started? Because if that answer hasn't changed the way you spend your hours, you're probably leaving the most valuable thing you have sitting on the table. Trap 6. The illiquid millionaire trap. This is a trap that's genuinely grown in scale, and it's catching more people every single year. Bloomberg dug into Federal Reserve and Census Bureau data from 2023 and found that households with a net worth between $1 million and $2 million had 66% of their wealth tied up in illiquid assets, mainly home equity and retirement accounts. 2/3 of what they own, they can't get to without going through a 6-month real estate transaction, absorbing an heirs penalty, or waiting until they hit 59.5. The illiquid millionaire is a specific kind of uncomfortable. Technically wealthy, practically boxed in, You can't jump on an opportunity because everything you have is either locked inside a house you'd be crazy to sell given the rate you're sitting on, parked in a retirement account that'll cost you 10% to touch early, or committed to a private deal with a 5-year lockup. Rich on paper, stuck in reality. The practical rule: 3 to 6 months of core living expenses sitting in actual liquid cash, not invested, not in a CD, not almost accessible, liquid. Beyond that, keep a close eye on the percentage of your total net worth you can get your hands on within 30 days without a serious tax hit. If that number falls below 15 to 20%, the portfolio needs a liquidity check before it needs anything else. Being technically wealthy while practically cash-strapped isn't a success story. It's just a nicer looking version of the same old trap. Trap 7. Letting your insurance coverage fall behind your growing assets. This one doesn't exactly make for exciting conversation, which is precisely why it does the damage it does. As your net worth climbs, you become a more attractive target in a lawsuit. That's not paranoia, it's just math. A 2023 ACE Private Risk Services survey found that 21% of high net worth households carry zero umbrella liability insurance. Meanwhile, 13% of personal injury awards now top $1 million. And large jury verdicts aren't getting smaller, they're getting bigger. One car accident, one guest who takes a bad fall at your house, one situation where the outcome goes sideways, and a judgment can reach right past your auto and homeowners' limits straight into your investment accounts. An umbrella policy layers $1 million in liability coverage on top of what you already have. The annual cost is typically somewhere between $300 and $600. A $5 million umbrella policy might run you $800 to $1,200 a year, still a rounding error against a serious portfolio, and the thing standing between a rough day and a financially devastating one. The full checklist grows right alongside your net worth: umbrella liability, updated homeowner replacement cost, higher auto liability limits, valuable articles riders for jewelry and art, and D&O coverage if you're running a business. None of this is hard to set up. All of it gets skipped because it's not interesting, and nobody reminds you to revisit it until something's already gone wrong. Trap 8. Confusing owning a lot of things with actually being diversified. You've got 6 ETFs. 4 of them are US large cap equity funds with slightly different names and nearly identical holdings. You've got a brokerage account, a 401k, and a Roth IRA, all invested in variations of the exact same thing. You feel diversified. You're not diversified. You're concentrated with extra steps. The deeper issue is correlation. In 2008, pairwise correlations between equity asset classes spiked from around 40% to nearly 70%. Everything moved in the same direction at the moment it mattered most. Owning small cap US funds alongside large cap US funds didn't help. International developed markets didn't help. Nearly everything dropped together because fear doesn't negotiate with your allocation percentages. Real diversification means holding assets that don't react to the same pressures. David Swenson ran Yale's endowment for 36 years, averaged 13.7% annual returns, and grew the portfolio from $1.3 billion to $42 billion by putting 60% into genuine alternatives, private equity, real assets, venture capital. His core insight was that real diversification across uncorrelated assets is what actually reduces long-term risk. Not the number of tickers you own, but the relationship between them. You don't need to build an institutional endowment, but getting some international exposure, adding real assets, and actually thinking about what moves independently from everything else, that's the difference between real diversification and a very convincing imitation of it. Trap 9. Panic selling once the dollar amounts get large enough to scare you. Here's the one that specifically gets worse the wealthier you become, and almost nobody talks about it that way. When your portfolio was $40,000 and it dropped 20%, you were down $8,000 on paper. That stung, but it was abstract enough that you could breathe through it and hold steady. When your portfolio is $2 million and it drops 20%, you've just watched $400,000 disappear. And your brain, which developed in a world where losing that much of anything would have been genuinely life-threatening, has no real framework for sitting with that number calmly. Loss aversion doesn't scale with your portfolio's ability to recover. It scales with the raw dollar figure, which means the wealthier you get, the harder it pulls on you to do something when markets fall. Dalbar's 2025 report found that in 2024, the average equity investor earned 16.5%, while the S&P 500 returned 26.3%. Stretch that behavioral gap out over 20 years, and $100,000 in a buy and hold index fund turned into over $750,000. The average investor ended up with less than half of that, nearly $372,000 left on the table. Not from picking bad companies, not from a crash, not from fees, from human behavior, from buying when things felt good and selling when they didn't. During the COVID crash in March 2020, investors yanked $326 billion out of funds in a single month. The market bottomed on March 23rd. It then rallied 70% over the next 12 months. Every dollar that ran for the exits at the low missed the entire recovery, because the dollar amounts had grown large enough to completely override rational thinking. The protection here isn't willpower. It's structure. Automating contributions so there's no active decision to make during a downturn. Writing your plan down before the crash so you've got something solid to hold on to when clear thinking goes out the window. Not checking the portfolio during volatile stretches unless something in your actual life has fundamentally changed. Lock in the strategy before the fear shows up, because once it does, you're running ancient wiring inside a modern financial system, and the ancient wiring almost always loses. Trap 10. No estate plan. This is the one people put off the longest because dealing with it means thinking about something nobody wants to think about. And that delay costs a fortune. Prince died in April 2016 with an estate valued at $156 million. No will, no trust, no estate plan of any kind. What followed was 6 years of litigation, 2,711 court filings, $45 million in legal fees, $60 million in federal estate taxes, and $24 million in Minnesota state estate taxes, roughly $87 million or 56% of everything he built, consumed by a problem that a proper estate plan would have largely taken care of. 2 of his 6 siblings died while the probate process was still dragging on. A $100,000 estate plan would have saved $87 million. That math is genuinely difficult to look at. Caring.com's 2025 survey found that only 26% of Americans have a will. Even among people with real assets, failing to plan is overwhelmingly the norm. A revocable living trust sidesteps probate entirely. Updated beneficiary designations on your 401k, IRA, brokerage accounts, and life insurance, each of which overrides whatever your will says, cost nothing to change. None of this is complicated. People just don't do it because it means sitting with an uncomfortable subject long enough to actually follow through. The Williams Group studied 3,250 wealthy families over 20 years and found that 70% had lost their fortune by the second generation and 90% by the third. Cornelius Vanderbilt died in 1877, worth the equivalent of $3 billion in today's money. By 1973, at a family reunion with 120 descendants, not one of them was a millionaire. Building wealth is one skill. Building it to actually last is an entirely different one. Go back to Liam and Harry for a second. Harry isn't a cautionary tale because he failed. He didn't fail. He worked hard, earned real money, and made a lot of right calls. He just didn't catch on to the fact that the traps shifted on him somewhere around the time his net worth crossed 6 figures. The risks got more sophisticated, more expensive, and nobody pulled him aside to explain that building wealth and protecting it are 2 completely different games requiring 2 completely different skill sets. Liam didn't get to $1.84 million because he was smarter or luckier. He got there because he understood, maybe just by instinct, that the real enemies of growing wealth aren't the obvious ones. Not market crashes, not job loss, not bad luck. It's the slow creep, the emotional decisions made when the dollar amounts are large, the inaction on the boring stuff that never feels urgent until it becomes catastrophic. Somewhere in this list, something hit home for you. Maybe it was the lifestyle creep. Maybe it was that concentrated position you're holding a little tighter than you should be. Maybe it was the will you've been meaning to update for the past 3 years. That moment of recognition is worth more than everything else in this video put together. Go fix that one thing. Just one. Don't queue up 10 more videos first. Go handle it today. If this helped you see something you weren't seeing before, hit subscribe, because this is exactly what we do here.